Hey everyone, welcome back to another dividend investing video. Real estate investment trusts. These are a great way for the average dividend investor to gain real estate exposure in their portfolios. You can invest in real estate without having the duties and responsibilities of the landlord side of things, which is quite convenient. 2023 was an interesting year for REITs. My belief is that it'll be looked at as an opportune moment in time to acquire quality real estate investment trusts at deeply discounted prices, especially a few months back in October. Now, as we begin 2024 with prices back on the rise, I thought this was a great time to highlight the 3 real estate investment trusts I think deserve the most attention for dividend growth investors for the coming year. And I'm going to leave Realty Income, ticker O, out of this discussion since that one is an obvious favorite amongst dividend investors. These are the other 3, aside from O, that I'm personally going to be continuing to focus on building my own positions throughout 2024. So let's dive in. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. So the first REIT I'm going to cover today is Agree Realty, ticker ADC. Agree Realty is an $8 billion industry leader in the acquisition and development of properties net leased to the foremost retailers in the United States. As of December 31st, 2023, the company owned and operated a portfolio of 2,135 properties located in 49 states and containing approximately 44 million square feet of gross leasable space. They lease to a lot of blue chip companies, as 69.1% are investment grade tenants. In fact, their top tenant is Walmart, who occupies 6.2% of their properties. Other prominent tenants include Best Buy, CVS, Kroger, Dollar Tree, Hobby Lobby, Lowe's, Home Depot, and even BJ's. They are diversified across various retail sectors and grocery stores at 10%, home improvement at 9%, tire and auto at 8.5%, followed by convenient marts, dollar stores. Nicely diversified. This is like a smaller version of Realty Income, ticker O, which I also like. ADC has actually been a superior investment over the last decade. It beats both Realty Income and the S&P 500 on a 10-year total return basis. ADC has a total return of 235% over the last 10 years compared to the S&P 500's 210% total return and Realty Income's 146% total return. Of course, past performance does not in any way guarantee future results, but I do think we have a lot more room for growth to continue with Agree Realty, and that's why I was buying it up in 2023. And 2023 was a good time to scoop up shares, I believe. I think they're still at a good place, currently down 11.5% over the last year. And the forward price to adjusted funds from operations of 15.5 is looking nice. It's a 20% discount to ADC's 5-year average P to AFFO. And remember, with REITs, rather than looking at price to earnings, not particularly meaningful for REITs, we instead look at price to adjusted funds from operations. By dividend yield theory, the current yield of 4.71% on ADC shares are 24% above the 5-year average yield of 3.79%. So another metric that is making ADC look undervalued. ADC is on a monthly payout schedule. It typically pays around the 15th of the month and goes ex-dividend at the end of the month. Currently, the non-qualified dividend is paying out 24.7 cents per share, paying out $2.96 over the last year. Now, what do I mean by non-qualified? Remember that dividends issued from REITs and also BDCs are typically taxed as ordinary income. That's what we mean when we say non-qualified. This is one reason I like prioritizing these stocks for retirement accounts. And I hold these kind of equities in both, and I don't let taxes fully dictate my investment choices, but you do need to know the facts. And this monthly dividend looks to be easily covered by adjusted funds from operations, as it's taking up 73% of adjusted FFO over the next 12 months. REITs are expected to have high payout ratios, and as long as it's under 90%, we are looking good. You can argue that Agree is doing great, as they have spent the last decade cutting this payout ratio down, slow and steady at least. Not only have they kept it from growing as the dividend grew, they've managed to improve on it. Now, Simply Safe Dividends assigns Agri Realty with a dividend safety score of 70, rated safe and unlikely to face a dividend cut. And ADC has grown its dividend at a rate of about 6% annually over the last decade. It slowed the last year, but consider their situation with the rate environment on these companies, I do see it as a blip. It is important to keep in mind that last time we had a recession, ADC did cut their dividend. Dividend growth is fueled by growing AFFO per share in REITs, and this has nearly doubled over the last decade, going from $2.13 per share in 2013 to $4.06 per share today. Another thing I like about Agri Realty is you'll often find their CEO, Joey Agri, on Seeking Alpha, engaging with investors in the comments section. And agree with his takes or not, you have to respect the willingness to put yourself out there and engage with us, investors. Now, the debt situation is not bad, and in comparison with their past, they've been doing better. Net debt to EBITDA is at 4.33, net debt to capital of 30%. Wall Street analysts are bullish on the company, generally rating it 4.53 out of 5, a strong buy. And out of 15 analysts, 10 rated a strong buy, 3 a buy, 2 a hold. They see some upside as well with an average price target at $66.79. It's about 7% higher than where shares are today. So was it a better time to be buying a few months ago? Well, of course, that's been the case for most REITs and really most stocks right now. But I feel just as solid holding this for the next decade as I do my shares of Realty Income. I plan on collecting these monthly dividends for the foreseeable, so I will continue to add to my existing position in 2024, albeit not as heavily, as I've gotten pretty heavy on real estate over the last year. ADC looks solid to me, and it is one of my top REITs for 2024. REIT number 2 is Vici Properties, ticker VICI. Probably not a surprise to see Vici on this list. And I'm going to admit this is a stock that's been very much hyped by many, but I do think the hype is well deserved. Now, Vici is an S&P 500 experiential real estate investment trust. They own and operate one of the largest portfolios of gaming, hospitality, and entertainment destinations, including Caesars Palace Las Vegas, MGM Grand, the Venetian Resort Las Vegas. These are 3 of the most iconic properties on the Las Vegas Strip. Altogether, Vici owns 92 assets across the US and Canada. Today's shares are trading just about the same price they were a year ago. It saw some ups and downs in that time. Vici hasn't been around a very long time, but its 5-year total return does surpass that of the broader market. The total return on Vici shares is 120% versus the S&P 500's 100%. Vici's price to forward adjusted funds from operations is 14.3, and its 5-year average is at 14.8, so it's right in line with its typical norm. Would not be at a discount that I see stocks like Agri and Realty Income, but I would argue these properties are going to fetch a premium. I'm happy to pay fair value for a quality business, and that P to AFFO is also right in line with the entire sector as a whole, so I certainly don't see this as an overpriced stock. Today's shares are yielding 5.24%, only 3% above its 5-year average, so by dividend yield theory, we are again seeing what looks like reasonable valuation. The dividend is paid out on a quarterly basis in the months of January, April, July, and October, in the amount of 41.5 cents per share for a total annual payout of $1.66. As a percentage of adjusted funds from operations, the dividend makes up 75%, and this is about what we would expect to see for this kind of REIT, and it's actually come down a few points over the last few years. This looks great. SimplySafeDividends.com assigns Vici a borderline safe safety score of 50, suggesting they see a moderate risk for a dividend cut over a full economic cycle. But consider this. If you think back to 2020, when there was a period when every casino on the Las Vegas Strip was legally forced to shut their operations and close their doors for a period of months, over that stretch, not one tenant missed their rent payments. But the risk you see here is a very small tenant base, highly concentrated, 12 tenants, but 3 of those tenants make up 83% of that annualized rent. So if one of them were to come into some major struggles, this could cascade over to Vici, where they maybe aren't making their rent payments, say, and this could affect things going forward. Good to keep in mind. But we do have a track record of 5 years of dividend growth. The latest raise was at 6.4% annual growth. They lack the track record of many others, but are off to a fantastic start. The dividend has grown at 7.6% rate annually over the last 5 years, beating out many of its peers. Growth is primed for the future here, with an AFFO per share on the rise every year since the company spun off about 7 years ago. We have an average analyst price target of $35.75, which suggests a potential upside of almost 13%. And even the lowest price target is higher than the current price, which is encouraging. I own Vici in both my taxable account and my Roth IRA. I even hold a few shares in my child's custodial account. It's a riskier play than some others, but I'm a huge believer in American tourism and the entertainment offered in Las Vegas as a world-class resort destination. I will be continuing to build this position in both of my accounts over the course of 2024, especially on dips. We'll keep tabs on this one throughout the year, so make sure you have that notification bell hit so you don't miss that next video. The third REIT for 2024 is American Tower REITs, ticker AMT. It's one of the largest REITs out there. They're a leading owner, operator, and developer of multi-tenant communications real estate with a portfolio of nearly 225,000 communication sites all over the globe, as well as a highly interconnected footprint of U.S. data center facilities. It's another one I'm super bullish on. Been buying at my Roth last year. I'd like to increase that by a few shares in 2024. Over the last year, shares are up about 1%. What happened was they really dropped over the majority of 2023, but like the rest of the market, shares continued to rise with the November and December market run-up. Things sure do change quick in these markets. AMT's 10-year total return performance has outshined the broader market, at least as of today, 220% total return versus the S&P 500's 207%. AMT shares look to still be at somewhat of a discount as well, at least in terms of price to AFFO. Today, it's at 21.5, while its 5-year average is 25.4, so that's a 15% discount to its own 5-year average, price to adjusted funds from operations. Today's shares are yielding 3.15%. Not huge for a REIT, but for AMT, this is 57% above the 5-year average of 2.01. So by dividend yield theory, this stock looks undervalued. AMT pays out in the months of February, April, July, and October. Over the last year, they paid out $6.80 per share. And as this beautiful chart shows, they've been raising their dividend on a near quarterly basis, with the exception of one quarter where it did not change over the last 3 years. Super impressive. That $6.80 annual dividend makes up 68% of forward adjusted funds from operations. While it's been steadily growing as they've been raising the dividend, it has the runway to do so. REITs are expected to be paying out as much as 90% of their AFFO as dividends. Simply Safe Dividends gives AMT a safety score of 78, rating it safe, unlikely to face a dividend cut. And this dividend growth chart does not look like a REIT, looks more like a Broadcom, Texas Instruments, or Lowe's. Over the last year, dividend has grown by 12%, given the multiple dividend raises announced over the last year. Over the last 5 years, the dividend has grown by 17% annually on average. Insane growth. Certainly see AMT as a superior investment going forward than some of its tenants, like your AT&T, ticker T, or Verizon, ticker VZ. I also love the huge chunk of international revenue there. And that smaller but growing sector in data centers is some fine diversification. The mobile data market is projected to continue seeing 20% compound annual growth through at least 2028. So I'll be freeing myself of AT&T and Verizon and going for AMT. The nature of these towers allows them to lease to multiple tenants, which greatly supplements additional revenues, while the cost to operate these are basically flat for AMT, whether they have 1 tenant, 2 tenants, or even 3 tenants. While Wall Street analysts set an average price target of $224.56, it's about 5% upside from where shares trade today. Of course, shares have gone up a bunch in recent months, but I do think it's still not overvalued territory. The company truly is all over the globe, impacts many of our day-to-day lives without us even thinking about it. So I'll definitely be looking to up my position here as I'm able. I definitely wouldn't mind seeing the price come back down a little bit some, however. And I want to know down in the comments, what are your top REITs for 2024? Or are you not focused on that sector this year? I'm assuming you are to some degree if you clicked on this video. And I'm much less focused on it than I was in 2023, but these 3 in particular, along with tried and true Realty Income, which I see as a staple core holding, are positions I see myself building hopefully for the next decade and beyond. Thank you so much for sticking around. Much more to come here in the new year. Stick to those resolutions, my friends. And until next time, keep investing.